Okay, so what's driving the stock market at this point? Because we've got a lot of concerns kicking around. The stock market doesn't seem to be too worried about it.
Yeah, we've talked about this all year. There's been a carousel of concerns, this rotating group of concerns that is able to capture the market's attention until fundamentals come up, smack us in the face, and remind us that things are still quite good. I think you've had continued strong economic growth. Yes, interest rates are higher, but they're still very much in benign territory, as is inflation. And the trade headlines this week weren't nearly as bad as I think some feared, with a 10% tariff instead of 25. I think collectively that's enough to move us higher.
So also joining us here is Lananh Nguyen. She's Bloomberg FX reporter. So the question, though, has been the rising yields versus the dollar. This terminal for me says it all. It's the 10-year yield versus the Bloomberg Dollar Spot Index, and that divergence and how that's not playing out in the equity market.
Yes, exactly. And this is a big conundrum for people in the markets. Why are yields going up at the same time as the dollar selling off? The explanation that I'm hearing from foreign exchange markets is that this is a risk-off move. Sell U.S. assets, get out of the dollar because EM is stabilizing, and look forward to what's happening next year in terms of central bank action. So people are done with the Fed. They want to know what the ECB is going to do, what the BOJ is going to do, and they're kind of thinking this is as good as it gets in the U.S. economy.
Is that right? They're done with the Fed? I mean, I haven't heard that lately.
I don't know about done with the Fed, but I can tell you that, the prevailing narrative has been that the Fed's going to go once a quarter between now and the end of time. We don't buy that narrative. We actually think that at some point in 2019, growth is going to continue to be fine, but inflation is going to continue to surprise to the downside, and the Fed's going to either pause or slow the rate of hiking next year, which, again, we still think that both of these charts are within their range. We think that the dollar is within the 10-year yield is within its 2.8 to 3.1% range. We think that the weakness in the dollar is transitory and should remain relatively stable in the year end. But as you get into 19, if the Fed does pause or slow the rate pace of tightening, you could very well see the dollar weaken. And I think that you may see a preview of that in the markets right now.